Hello, welcome back. So in your last lecture video and your last participation assignment, you guys were tasked with calculating the product cost per unit under the absorption method and under the variable method. And so now that we have a better understanding about that, we'll be able to move on to the income statement preparation under both of those methods, absorption and variable. So moving on, first we will do the income statement under the absorption method. And if you remember from our last video, the format for the absorption income statement, it was our last video, it follows the traditional income statement format. Sales, cost of goods sold, gross profit, operating expenses, and net income. That format that you were familiar with in Accounting 1A. Whereas the variable income statement is going to have the format that you were introduced to this semester for a contribution margin income statement, which will be sales minus your variable costs, gives you contribution margin, minus your fixed costs, gives you net income. Okay, so we're going to start with absorption. So we have our header here, name of the company, Ice Age in this example, income statement, and then we place in parentheses which method this income statement is prepared under. So absorption. Now notice you guys haven't seen that up until now. You've just seen an income statement. That's because absorption method is the only method permissible for external reporting. So everything that you've seen was under absorption, and they didn't need to reiterate that because it's the only one that's acceptable for public use. And then we have for the year ended December 31st, the first year we'll be preparing the income statement for is the first year presented, which is 2009. All right, so we have our format there. Let's go ahead and start. So we know that we start with sales, revenue, sales. To figure out our sales, we're going to need to take the number of units sold in 2009, which was 60,000 units, and we're going to multiply it by the sales price per unit. So if you go back to the first sentence, sales price is 40. Multiply to get $2.4 million for your sales revenue under the absorption method. Next, we know that we have our cost of goods sold. Cost of goods sold is calculated the number of units sold, so again, 60,000, times your cost for each one of those goods, each one of those units. We already figured that out, so we're doing the absorption method first, so your cost per unit is 25. You should get 1.5 million. Subtract that to get your gross profit or gross margin, same thing. Gotta have a straight line there, sorry. And that gives us $900,000 for our gross profit. Continuing on, we're gonna subtract our operating expenses. We know operating expenses are selling, general, and administrative. Okay, so let's leave a little bit of room because we have two of those period, also known as AKA op costs or op expenses. We have variable selling and admin and fixed selling and admin. So I know they're all selling and admin, but they're separating it for based on cost behavior for when we get to the variable method. Alrighty, so we have our variable S&A and our fixed S&A. All right, so variable, $2 per unit. And again, how many units? 60,000. That gives us 120,000. The fixed, you can just take the total since it's already calculated that way for us. Subtract your operating expenses from your gross profit to give you net income of 580,000 for your net income. Easy peasy. Good. Now we're going to go ahead and move on to the variable format. Okay, so your three-line header again, name of the company, income statement, and then in parentheses you can put the method that we're using. It's now variable. And then for the year ended December 31st, 2009. Start with sales. Sales is always going to be the same. It's going to be the 2.4 Next we're going to have, and again we're using the contribution margin format, so next is going to come your variable costs. So variable costs, variable costs. Give yourself some room because you have two types of variable costs. You have your variable product cost and you have your variable selling and admin. So product costs and selling and admin. Okay, so your product costs, it's $15 per unit. We got that from our unit computation up here. So 15 times the number of units sold. So 15 times 60,000, and we should get 900,000. Okay, S&A. The S&A we remember is $2 per unit times the units sold, which is the same as it was in the previous example, 60,000 units sold, so that gives us the 120 that we had over here. All right, subtract all your variable costs from sales. We know that gives us contribution margin. So you're going to get a contribution margin of $1,380,000. Now, fixed costs. Again, you're going to have two types of fixed costs. You're going to have this fixed selling and admin, and you're going to have this fixed overhead. Because remember, under the variable, the fixed overhead is not a product cost. It's considered a period cost. Oh, sorry, I don't think you can see that. Yoink. Let me move it over a little bit so you guys can see that. Yeah, it's all very high-tech here. Sorry, guys. Okay, so I was mentioning that your fixed overhead is not treated as a product cost, but as a period cost. Period costs go on the income statement. So we're going to see all that fixed overhead, that's $600,000. We're going to see that here under manufacturing overhead, $600,000. We also have our fixed S&A up here, selling and admin of $200,000. So subtract this $800,000 from the 1.3 that you got earlier, and you're going to get a total of $580,000 for your net income. Okay, your format is similar to the income statement from way 1A with respect to your dollar signs on the first and last number and the double underlines. Okay, so we notice something interesting here. We notice that our net income is the same. Okay, so it's the same under both methods. Do you think that's always going to be the case? Well, let's see in the next 2 years, because remember this problem asked us to prepare the income statement for each year. We have 2009, which we just did, 2010, and 2011. So go ahead and try the other 2 years on your own, and then I will post a solution video with that information, and you'll be able to answer the question, is net income always the same?